Hey, good day, everybody. We're going to take a look a little bit different than what we've been doing in the course. We're going to take a look at a live trade and a scenario that came up today that was really an awesome explanation of the power of using the system, in the sense that you protect yourself in unknown volatility. So Friday was corn crop report, and I'll go ahead and put it up there. So this is we're going over Curvy here. This would be the session on Friday. You open right here. So the way I set this one up is I'm using regular trading hours as opposed to the 24-hour market. I use that on corn because it really, I just want the most volatile time of corn. Sometimes I do it differently on the other products that I trade. But on corn, I found that if nothing else, just the simplicity of it is additive as opposed to just taking away from the whole scenario. So as you can see over here, there was a scalpy setup, or I'm sorry, a curvy setup, the mean reversion system here, and I got in here, and then you can see that the volatility went just bonkers at 9 a.m. my time, 11 a.m. Chicago, where this thing trades. These are 10-minute candles, so it's hard to see what happened. But I got into the trade, and this was done during the live stream of the trading lab. So there was, I don't know, a dozen lab members with me at the moment when we were getting going, when this trade was getting started. And so they at least they got to play along. Whether they took the trades or not, that's on them. That's how they run their business. But what I do is I like to just, show the trades that I'm in or doing when I am trading. So as you can see, this was a short. I got in short, and it moved into my favor about 1 hour by the time we were getting close to the crop report. So where I usually have my stop, I moved my stop to break even plus 1 tick, especially because the crop report was about to come out. But more importantly, that's part of the trading plan. That way it's a simple, repeatable. I don't have to think about the market. I don't have to think what's coming up next. I don't have to contemplate news. I don't have to do I just follow the trading plan. Now, in this instance, had I not been at 1 hour already with a locked in profit already, I would have just exited the trade going into the crop report, because as you can see, the price went from 677.6 down to 673 in seconds. And then within that 10-minute window, it went from 673 all the way up to a high of 696. Big move. In that was, we were talking like, I think, a 5% move or so in a quick window. And I'll put it down to like by the tick. We'll be able to see how this trade went out. Now, the other thing I like to do with this system is I put a 2-hour price target on there. Now you can use midlines, or you can just, trail stops or whatever. But because we're talking about a mean reversion system, it reverts to the mean. It doesn't take off, and we're not looking to catch the big rips that go. We have a system, we have an adjustment for that, how we would do that. But in our mean reversion setup here, we're not looking to do that. We're catching high win rates, highly predictable, highly scalable. So this trades bonds, I trade crude, I trade corn, and I trade either NASDAQ, S&Ps, Dow, or Russell. And these are the biggest contracts out there. And so there's no problem with me and 100 of my best friends trading the exact same thing, because hundreds of thousands of contracts are traded a day on corn alone. Corn is the lowest volume product of the 4 that I trade. Bonds can, I don't know, billions of bonds trade. So back to the trade. So I put my stop above here. I put my entry in here. I got short. It moved in at least 1 hour. So one time my risk. So all I needed to do is make sure I paid my bills. If the trade got stopped out, I paid for the commission, so it didn't chew away at the opportunity. And then I had my profit target down here. Now, you can't see within the 10-minute chart how that actually went. So let's go down to the 1 minute. And also the 1 minute, you can't exactly see the, okay, here it is. Okay, you can't exactly see the trade, but let's make this guy a lot smaller. I don't think you can see the trade here. So let's make this guy, oops, a lot smaller too. Wow. It's crazy what the lines you put on a 10-minute, how big they actually end up being, huh? So this would have been the, I believe this, or somewhere in here was the short, somewhere around there. So I'm going into the trade. And then the last 10 minutes going into the trade, it starts working in my favor. So early in, when we started the lab session, I mentioned that I got short corn. And then about 10 minutes later, it started moving my direction. So we can't actually see this on that 1 minute chart either. You can see that this thing traded up 2.5%, traded all the way down here, and then traded all the way up 2.5% in 1 minute. That's a 1 minute chart, not a 10-minute, not anything else. So let's do like 30 seconds. Let's see if we can see it in a 30-second chart. Okay, there we go. Okay, let's do 15-second now. Jeez. This is wild. Okay, here we go. Now this shows, you can see that when the news came out, it went down, hit my profit target, and then came right back up, and then right back into here. Another 15 seconds later, it did that. So 30 seconds in, finally, it rips higher. Again, this is a 2% candle. This is a 0.5%. So this is a 2.5% move in 30 seconds. I think maybe we need to go in shorter so we can see that it went down first to hit the, yeah, okay, that should do it. Jeez. Actually, it doesn't. Yeah, it does. Okay, it does. Cool. Okay, I'm sorry that this is so, like, we're looking at 5-second resolution. So each bar is 5 seconds. You can see how dead it got as it moved into the thing. So my short was here. My earlier from somewhere somewhere in here, I was already short, and then so my stop was there. So when this thing broke, see how it broke down, hit my price target first, hang out down there, and then it ripped up to where the actually that's 1 hour, so it got short over here. So it went from the 1 hour profit target to the 2 hour profit target, exited right here, hit my profit, boom, boom, boom. They took my contracts. That was a short, so I bought back out, and then it rips back up to where I would have been stopped out at, and comes back in. And apparently there were others that were the liquidity seeking engine ran both of those areas. In a game of luck, it went in my direction first. It wasn't skill. It wasn't the system that made it go in my direction, because it could have done the opposite. Even though the momentum was down, it could easily have ran this stop up here, which was my break even plus 1 stop, and then came down, hit my profit target, and then ripped up here. It could have also just went straight up to the top, which is why the break even profit target was, or a break even stop was in place to make that really safe. Now, had I not already been 1 hour in profit at this level, I would not have sat through that. So if you're trading things like NASDAQ, if you're trading Apple, if you're trading TLTs or spiders or bonds as you go into the FOMC announcement, or non-farm payrolls, or CPI, PPI, or something like that, where you're expecting huge volatility at a known point in time, right? We knew that 11 a.m. Central was the crop report, so we would expect the most volatility of the week to happen right there. If you're not already in the position, you stay away. You move far away, because had I had I initiated the position and here and it didn't start dropping to my profit, well, I would have just been out as we approach the time frame. I know a lot of traders want to they want to catch that volatility of that moment, but when I'm looking at let me think how many trades were done. Let me look at how many trades I did last week. Trying to count this out here. We did, starting the 22nd. I had 24 trades last week. You don't see that spreadsheet. I had 24 trades during the week. And so it was a 5-day week. So that's a little bit more than 4 trades a day. One of them was an extreme volatility trade, but it was a 2-hour trade. If this one would have been a loss, it would have been 24 trades that was a -1. Instead, it was one of the 24 trades that was a +2R. If you're going into like an FOMC day and you're already in a position like this, that's how you would do it. You would move your stops into the right location and hope for the best. Best case scenario, you don't even play it. You just take that one off, because had I taken just this one trade off, then I would have had 23 trades and my returns would have been, 2R less on the week. But again, over the course of 4 trades a day. Now, on average, so it would have been a little bit almost, actually it's closer to 5 trades a day at 24. And also, if you're looking at, let's say, trading Apple, let's say you're trading, you want to trade stocks, you want to trade currencies with Forex, or you want to trade crypto, all these things apply. The same system applies. I'm trading this on a 5-second, but let's take a look at maybe a 1 week and see if we can see how. So that would have been in June. So the thing I want to point out is just it moves from side to side here, right? Which means you could trade this on a weekly chart. So every weekend you take a look and make a decision. You could trade this system on a daily chart. So at the end of every day, you take a look. If you're busy throughout the day, maybe you want to trade it on a 4-hour or a 1-hour. You can find spots all over the place where you're moving from the top to the bottom to the top to the bottom. For me and a lot of traders with me in the trading lab, we like to trade it on lower time frames so we can get those 4 to 5 trades per day, like we're doing here. As you can see my layout, I've got corn, I've got crude, I've got NASDAQ, and I've got ultra 10-year bonds. And you can see we move from side to side on these things quite often. The importance is not the indicator. The indicator is not the thing that's important. It's the price action. The indicator is something that lets you identify that there are algos. If certain things happen at edges of this indicator, that means the algos are there to play. The main deal on this curvy system is to piggyback on the algos. When the algos are running stops, that's where we want to be, starting to pay attention and get in. When they start running their stops, everybody's off the bus, and we'll be jumping on at that point in time. So there's some very specific things that need to be identified and deployed when we run this system. And that it's a simple, repeatable, predictable. It's predictable that you will have a trade potentially on the cards. And when you know that what your trade's expectancy is, that is how much you would make if you, over the course of 100 or 1,000 trades, how much would you earn? Your expectancy tells you that. So on 100 trades, if I was to do 100 trades and each trade would be worth 0.65R on this system. So $2 or 2R winner, 1R loser, 2R winner with a 70-something% win rate. That really, that over 100 trades, I'll have 65R. Using this logic in 4 weeks, at about 24 trades per week, 4 to 5 weeks, I should have 65R in my account. That's the way the system is. You can predict it in the future. Okay. That's it for today.